Today, we are going to discuss some basics of money markets. People often get confused with terminologies such as money markets and capital markets. Although there is no need to know this difference if you know the nature of financial instruments or financial product available in these markets. However, we need to do this because knowing the nature of financial instruments is not possible at an early stage of learning. Well, the money markets are actually an avenue where financial instruments or contracts having a maturity of less than 1 year are traded. Conversely, in capital markets, financial instruments or contracts having a maturity of more than a year are traded. This distinction in terms of a period of 1 year tells us that the money markets are available to exchange funds for a shorter period than is the case with capital market. Therefore, individuals and businesses that want to borrow money for a short time will visit appropriate money markets. Likewise, someone wanting to lend or invest for a short time will tap into capital markets. Interest rates in the money markets are relatively low as compared to capital markets. This deals a lot with liquidity risks as the money market lending or investment is for a short time, the liquidity risk is low. Therefore, the lenders are willing to enter the money market at a relatively lower interest rate. In other words, the liquidity premium in money markets is low, I would say. Another aspect of the money market is that much of the borrowing is made by financial institutions and the government, making the money market less credit risky as compared to the capital markets. Of course, the government would not default on its local currency borrowing, and also definitely financial institutions facing a strict regulation will not default in general. The reason a borrower will like to enter the money markets are these. Number one, as the interest rate in the money markets are low, the borrower like to use it for lowering financial costs. This reduces the cost of capital of a business, and ultimately this increases the value of a business. Finance managers with an aggressive funding style use short-term funds and thus visit money market more often. Number two, money may be needed for a short period of time. Therefore, borrowing through capital markets will be costly in every sense. Number three, entering the capital markets may be complicated because of the complexity and vagueness of relevant regulations. The reason a lender will like to enter the money markets are these. Number one, the lender has expertise in one or more money markets. Number two, the lender may need money back within a short period of time. Number three, the lender's cash flow cycle is such that cash inflows and cash outflows do not follow a similar pattern. This means there are businesses that will accumulate a big pool of money at a specific points of time during the year, and then these pools will be used to fund the cash outflows throughout the year. Therefore, at the instance of each of the point where the size of pools is larger than the immediate outlay requirement, the excess funds can be invested through the money markets. This will ensure the money would be available again within a short period of time, and at the same time the firm will be earning some return, albeit a lower return. The prime examples of such entities are tax authorities and universities. Number four, the interest rates in the capital markets are expected to decline more than the money markets in a relative sense.